She did everything carefully. She never gambled with her money, never bought individual stocks, never touched crypto, never fell for anything that seemed too good to be true. When friends talked about investing, she smiled politely and kept her savings where she knew it was safe. A savings account, FDIC insured, guaranteed, completely protected. For 25 years she did this. Faithfully, carefully, responsibly. At 58, she sat down to calculate whether she could retire at 65. The answer was no. Not even close. Her savings account, funded by 25 years of careful, consistent, responsible saving, had grown to approximately $180,000. At her current spending level of $52,000 per year, that was less than 3.5 years of expenses. She hadn't gambled, she hadn't lost money in a crash, she hadn't made a single reckless decision. She had simply made the choice that felt safest every single year for 25 years, and that choice had quietly, invisibly, mathematically guaranteed her financial shortfall. Here is the uncomfortable truth that most financial conversations never say out loud. In the long run, the safe choice with your money is not the safe choice. It is the most reliably damaging choice available to you. It simply damages you slowly enough that you don't notice until it's very difficult to recover. Real risk is not just the possibility of losing money quickly. Real risk is the certainty of losing purchasing power slowly. Real risk is reaching the end of your working years without enough to fund your own life. And the safe choice, savings accounts, cash under the mattress, paralysis, is the most direct path to exactly that outcome. Today, we're going to completely reframe what risk actually means. And by the end, you will understand why the most dangerous financial decision most people make is the one that feels the most responsible. Let's begin. When most people hear the word risk in a financial context, they think of one thing: the possibility of losing money. Specifically, losing it quickly, visibly, in a way that shows up on a statement and causes immediate pain. This is called volatility risk, and it is real. Stock markets drop, portfolios decline, sometimes dramatically. The S&P 500 fell 34% in 5 weeks in 2020. It fell 57% over 17 months in 2008. These declines are real, they're painful, and the fear of experiencing them is completely rational. But volatility risk is only one type of financial risk. And obsessing over it while ignoring the other type is like being so afraid of tripping that you never leave the house and slowly starve because you won't walk to the grocery store. The second type of risk is called purchasing power risk, or sometimes inflation risk, and it is both more certain and more destructive over long periods than volatility risk has ever been for patient investors. Purchasing power risk is this: the guaranteed, continuous, silent erosion of what your money can actually buy every single day, regardless of what you do with it. Inflation does not care whether you invest or not. Inflation does not care whether your money is in a savings account, under your mattress, or in a checking account. It operates continuously on all dollars, in all accounts, at all times. At 2.4% annual inflation, the current U.S. rate as of early 2026, the purchasing power of money held in cash or near-cash accounts declines by approximately 2.4% every year. That doesn't sound catastrophic. It isn't in year one. It compounds into catastrophe over decades. $100,000 held in a savings account earning 4% interest, with 2.4% inflation grows in real terms, in actual purchasing power, at approximately 1.6% per year. After 10 years, approximately $117,000 in real purchasing power. After 20 years, approximately $137,000 in real purchasing power. After 30 years, approximately $161,000 in real purchasing power. $100,000 invested in a diversified stock index fund, earning 10% annual returns, with the same 2.4% inflation, grows in real purchasing power at approximately 7.4% per year. After 10 years, approximately $204,000 in real purchasing power. After 20 years, approximately $417,000 in real purchasing power. After 30 years, approximately $851,000 in real purchasing power. Same $100,000, same 30 years. The safe choice produced $161,000 in real purchasing power. The risky choice produced $851,000 in real purchasing power. The gap is $690,000 from the same starting amount over the same time period. And the safe choice produced that outcome with absolute certainty. No crash required, no bad luck necessary, just the mathematical inevitability of growing slower than you need to. That is the risk nobody warns you about. Because it's quiet, because it's slow, because it never shows up on a single statement as a dramatic loss. It simply accumulates invisibly, patiently, and with total reliability, until one day you sit down to calculate your retirement and discover the damage has already been done. Let's make this even more concrete. Because the numbers are important, and most people have never seen them laid out this clearly. We are going to follow three people. Same age, 30 years old. Same starting amount, $10,000. Same monthly contribution, $400 per month. Same time frame, 35 years until age 65. The only difference is where they put the money. Person 1, the ultra-safe approach. Keeps everything in a checking account or under the mattress. Earns 0% return. After 35 years, $10,000 plus $168,000 in contributions equals $178,000. But inflation at 2.4% means that $178,000 has the purchasing power of approximately $73,000 in today's dollars. They contributed $178,000 over 35 years and ended up with the equivalent of $73,000 in real wealth. They lost more than half their purchasing power without losing a single dollar to a market crash. Person 2, the safe savings approach. High-yield savings account. 4% annual return. After 35 years, approximately $357,000. In real purchasing power after inflation, approximately $148,000 in today's dollars. Better than zero, but still, $168,000 in contributions. $148,000 in real wealth, barely broke even in real terms. Person 3, the risky investment approach. Low-cost S&P 500 index fund. Historical average 10% annual return. After 35 years, approximately $1.45 million. In real purchasing power after 2.4% inflation, approximately $601,000 in today's dollars. Three people, same starting point. Same monthly discipline, same 35 years. UltraSafe, $73,000 in real wealth. Savings account, $148,000 in real wealth. Index fund, $601,000 in real wealth. The risky choice produced 8 times more real wealth than the UltraSafe choice, more than 4 times more than the safe savings approach. Now ask yourself a different question. Which of these three outcomes is actually the most dangerous? The one that ended at $601,000 experienced volatility along the way, scary headlines, temporary drops, years when the balance went down before going back up. But it ended with enough to fund a comfortable retirement. The one that ended at $73,000 never experienced a single volatile moment. Every statement showed a stable, growing balance, but it ended with less than 1.5 years of average retirement expenses. Which outcome represents real risk? The one with volatility, or the one with certainty of inadequacy? Here is where this gets fascinating and important. The reason most people chronically choose purchasing power risk over volatility risk is not stupidity. It is not irrationality. It is the completely predictable output of human psychology operating exactly as it evolved. Our brains were not designed for long-term financial planning. They were designed for survival in environments where immediate threats were the only threats that mattered. A predator in the grass right now is a real threat. A gradual depletion of resources over 30 years is an abstraction too distant to trigger the same response. Volatility, a market dropping 20%, feels exactly like a predator in the grass. Immediate, vivid, threatening. Your brain activates the same fight-or-flight response. Your heart rate increases. Your focus narrows. You want to act to do something to escape the threat. Inflation eroding your purchasing power over 30 years feels like nothing, because it is nothing in the moment. There is no alarm, no statement that says, warning, your wealth declined by 2.4% in real terms this year. no visceral signal that something is wrong. Daniel Kahneman, the Nobel Prize-winning psychologist who founded behavioral economics, described this as the difference between System 1 and System 2 thinking. System 1 is fast, automatic, emotional. System 2 is slow, deliberate, analytical. Volatility risk triggers System 1, immediate threat response, powerful, urgent. Purchasing power risk requires System 2 to even perceive. It demands deliberate calculation, long time horizons, and the ability to feel concerned about something that produces no immediate sensation of danger. The result is predictable and universal. Human beings consistently overweight visible, immediate risks and underweight invisible, gradual ones, even when the gradual ones are mathematically far more destructive. Loss aversion compounds this further. Kahneman's research found that losses feel approximately twice as painful as equivalent gains feel pleasurable. Losing $1,000 feels twice as bad as gaining $1,000 feels good. This means the prospect of a temporary 20% market decline feels roughly twice as painful as the prospect of a 20% gain feels appealing. People will accept dramatica. Lower expected returns to avoid the feeling of loss, even temporary paper losses that have always recovered. The financial industry knows this. Conservative investment products are marketed directly to loss aversion, promising safety and stability while quietly delivering the guaranteed inadequacy that comes with subinflation returns. You're not being protected by these products. You're being charged for the privilege of feeling safe while inflation does its quiet, certain work. Let's talk about what the so-called risky choice has actually produced historically. Because the fear of stock market investing is almost always based on the worst moments, the crashes, the headlines, the dramatic declines, rather than the complete picture. The complete picture is remarkable. The S&P 500, the benchmark index tracking the 500 largest U.S. companies, has delivered positive returns in approximately 73% of all calendar years since 1928. That means roughly 3 out of every 4 years. Patient investors ended the year with more than they started. The 27% of years that delivered negative returns produced an average loss of approximately 13.5%. The 73% of years that delivered positive returns produced an average gain of approximately 21%. The asymmetry is significant. Down years are less common, and on average less extreme than up years are common and extreme. But here's the number that should permanently reframe how you think about market risk. Over any rolling 20-year period in U.S. stock market history, any start date, any end date, a diversified index investor has never lost money in real terms. Not through the Great Depression, not through World War II, not through the stagflation of the 1970s, not through the dot-com crash, not through 2008. 20 years of patience has produced positive real returns. Every single time. The savings account cannot make the same claim. At various points in recent history, the 2010s especially, savings account interest rates fell below inflation for extended periods, guaranteeing negative real returns regardless of market conditions. The safe choice offered a guaranteed negative real return. The risky choice offered a historically reliable positive real return over sufficient time. Now let's look at specific crash recoveries, because this is where the fear lives and where the data is most clarifying. The 2008 financial crisis. The S&P 500 dropped 57% from peak to trough. Catastrophic, headline-generating, genuinely terrifying to experience. An investor who put $100,000 in at the peak in October 2007 watched it become $43,000 by March 2009. By 2013, 4 years later, that same investment had recovered to $100,000. By 2017, it had grown to approximately $180,000. By 2024, it had grown to approximately $340,000. The investor who panicked and sold at the trough in March 2009 locked in a 57% loss permanently. The investor who held, who did nothing, who perhaps kept contributing through the decline, ended up with $340,000 from a $100,000 investment that at its worst moment was worth $43,000. Doing nothing was the highest returning strategy available. The risky, asset rewarded patience with returns that made the temporary terror completely irrelevant in long-term outcome terms. Understanding that safe is actually risky doesn't mean all risk is good risk. It means the right risks, calibrated to your timeline and situation, produce dramatically better outcomes than the wrong risks, the ones that feel safe but guarantee inadequacy. Here is a framework for thinking about risk correctly. Principle 1. Time horizon determines appropriate risk level. Risk is not a fixed property of an investment. It is a relationship between the investment and your time horizon. A stock market index fund is high risk for someone who needs the money in 2 years. The same fund is relatively low risk for someone who won't touch the money for 25 years. The historical record makes this clear. Over 20-plus year periods, diversified equity investing has never failed. Over 2-year periods, it can and does produce significant temporary losses. Match your risk to your timeline. Money needed in under 3 years. Savings accounts, treasury bills, money market funds, capital preservation, modest returns, completely appropriate. Money needed in 3 to 7 years. A blend of bonds and equities. Balanced approach. Some growth potential with reduced volatility. Money needed in 7 or more years. Diversified equity index funds. Full exposure to market returns and market volatility, with sufficient time to recover from any decline history has ever produced. The mistake most people make is applying short-term risk logic to long-term money. They protect 25-year money as if they need it tomorrow. The result is guaranteed inadequacy instead of manageable volatility. Principle 2. Diversification is the only free lunch in investing. You do not need to take concentrated risks to earn strong returns. A single stock can go to zero. A diversified index fund, owning hundreds or thousands of companies, cannot go to zero unless the entire economy collapses simultaneously. Principle 3. Volatility is the price of admission, not the cost of losing. This is the reframe that changes everything. When you invest in equities, you will experience volatility. Your portfolio will decline in value in some years, significantly in some decades. This is not a malfunction. This is the mechanism by which patient investors are rewarded while impatient ones are filtered out. The returns of the stock market, averaging 10% annually over a century, are not free. They come with a price: the willingness to hold through periods of decline without selling. Understanding this transforms how you experience market declines. A 20% drop is not a loss, unless you sell. It is a temporary repricing of assets you still own that will recover based on every historical precedent available. Principle 4. The emergency fund is what makes long-term investing psychologically possible. The reason most people cannot hold through market declines is not weakness. It's that they need the money. An investor without an emergency fund who experiences a market decline simultaneously faces a job loss, a medical bill, or any unexpected expense, is forced to sell investments at the worst possible moment. They have no choice. The money is gone when they need it most. An investor with 3 to 6 months of expenses in a savings account has a buffer. The emergency fund handles the unexpected expense. The investments can be left alone to recover. The buffer is what converts volatility from a genuine threat into a temporary discomfort. Build the emergency fund first, then invest everything above it for the long term. The savings account protects the investment account from being disturbed at the wrong moment. That is its proper role, not wealth building, but protection of the wealth building process. I want to close by offering you a completely different definition of financial safety. Not the conventional definition, the absence of volatility, the guarantee that no statement will ever show a negative number, the feeling of security that comes from money sitting still. The real definition of financial safety is this: the probability that your money will be sufficient to fund your life when you need it most. By that definition, the only definition that actually matters, a savings account is not safe. It is a near certainty of inadequacy delivered smoothly and comfortably over decades. A diversified equity index fund is not perfectly safe either, but it is the most historically reliable path to the outcome that real safety requires: enough money, growing fast enough, for long enough, to actually fund the life you're planning. The woman from the opening of this video did everything carefully. She never lost money in a crash. She never made a reckless decision. She was, by every conventional measure, financially responsible. And she arrived at 58 with 3.5 years of expenses, because the choice that felt safest was the choice that guaranteed the outcome she was trying to avoid. Real safety is not protecting your balance from volatility. Real safety is protecting your future from inadequacy. Those are different goals. They require different tools, and confusing them is the most expensive financial mistake most careful people ever make. The money you're keeping safe right now is not safe. It's losing purchasing power at 2.4% per year. It's growing at a fraction of the rate your future self needs. It's producing the comfortable sensation of security while quietly building a retirement shortfall that will feel anything but comfortable in 20 or 30 years. The actual safe choice, the one that gives you the highest probability of having enough money when your life depends on it, is the one that feels risky, the one with volatility, the one with scary headlines, the one that requires you to hold through declines without flinching. That choice has produced positive real returns over every 20-year period in market history. Your savings account cannot say the same. Here is what I want you to do this week. Calculate how much of your money is sitting in accounts earning below 7% annually. That's how much is growing slower than your future needs. That's how much is choosing comfortable inadequacy over productive discomfort. Then ask yourself honestly, is this money safe, or does it just feel safe? Because there is a difference, and the difference is worth hundreds of thousands of dollars over the course of a life. The safe choice is the one your future self can live on. Make sure you're making it.